I always like to start off the week, of course, with a summary of what happened with the stock market. So you can see the S&P 500 here so far this year. This really amazing run we've had since the middle of June, where we hit a bottom. We dropped 24% from the high to the low. The blue line there is the 200-day moving average. We're starting to get closer to that. What happened this week was the first couple of days we were down, and then Wednesday we had the CPI report for inflation. It came out lower than expected. Market jumped. And really important jump, because if you look closely at this, there was 8 days back in June and 8 days that ended this Tuesday where the market was basically just hitting the same barrier over and over. And that was the highest resistance level that we have for the S&P 500 over the last 2 years. And so when the number came out lower, it jumped over that. And so that now becomes support. So it's fairly significant support. And then yesterday, the market, Wednesday, the market's up a lot. So then you worry, is it going to give it all back? And Thursday, the market came down just barely, basically sideways. That's perfect. That's exactly what you kind of want to see. And then today, it's roaring off. And we're going through some other barriers here on the way up that are really important. We're still trying to determine for sure if this is the reversal and we're going back up to better days and higher highs, or if this is just sort of a fake bear market rally, they call it, where we go back to another low. So there are a couple things coming up here that are going to be important to watch. So first of all, draw this little yellow line here. This yellow line shows a 50% retracement of the loss. So in other words, we hit a high in January, a low in mid-June, and now we're just above today that 50% retracement. So we've come 50% back. There have been a couple articles out. Bloomberg's had one, Market Watch, and what they're saying is that a bear market, which is when the market goes down 20% or more, and that's what we have here, and once it retraces halfway and closes above that, so today it would have to close above that, so we'll see what happens, but it looks good. It's moving very strongly as we speak. If it closes above that, it has never had a situation where the market went back to establish a new low. Doesn't mean the market won't go back down some, we'll have some volatility or what have you, but that's super significant because that's what we're trying to determine here. Was June the low? And we're kind of out of the woods as far as that goes, and maybe we have some volatility, but eventually, things do start to come around or not. So that's a very interesting stat, and we'll see how that plays out as far as that goes. And then the next thing that we have coming up is that blue line there that you see is the 200-day moving average. That's a really big indicator for a lot of traders when the stock market jumps through, above that 200-day moving average. Oftentimes they look at that as a reversal of trend. So that's our next, barrier that we're looking at. It's not that far from where we are right now. Really, it's about 43.30 on the S&P 500. We're at about 42.60 right now, as we speak. So not far from that. We'll see how that works. And then the next one, I drew in a trend line here, just kind of connecting the top point that we had in March, end of March, and the top point, for the all-time top point for the market back in January. And you can see that actually is kind of converging with the 200-day moving average. And so those are like check boxes. We get through this big barrier we just got through on Wednesday. Good. That becomes support. Hey, we close above this 50% retracement. Good. Market's never retraced to a new low before in a bear market, so that's good to hear. We get through the 200-day moving average, get through the trend line. I mean, we are definitely having some potential there for a reversal trend completely and start to move back in the right direction. So that's why on Wednesday when the inflation number came out, we removed all of our treasury positions and moved back into our full normal allocation. If somebody had a 60% exposure to stocks, we had reduced that for a while here just because the yield curve inverted, the leading indicators peaked out, and those types of things, which can be indicators of problems for the stock market. They can sometimes be early, so we'll see what happens coming up later. But now that we've broken through all these barriers on the upside, it's time to get back into the full exposure. And so we're back in. If you have a 60% position, we've moved back into that position. So so far, so good as far as that goes. And really, the main catalyst, of course, this week was the CPI number, the Consumer Price Index. This is what most people are familiar with. And this is the last year, and it's kind of incredible. You can see that it dropped, right, from that all-time high. It was at 9.1%. It dropped to 8.5%. And this is a basket of goods that the that they look at to determine, how much they grew versus last year. So July of last year versus July of this year. And the other thing that people are looking at that they're kind of excited about is the fact that a lot of these leading indicators for inflation, commodity prices, have been coming down. A little bit of move up later on in this week, so we'll see how that plays out. But that those things like gas and such that have been coming down, and so that's sort of making people feel better. Core inflation, where you take out food and energy, basically held the same, which was better than expected. They thought it would go up, right? So that's good as far as that goes. But you have to understand that the key driver here is really kind of energy, because energy itself is a category. It is in that top line inflation number of 8.5%, but it's also in everything we do. If you go to the restaurant, they're having to pay for higher energy costs to get food delivered, wholesale food delivered, and those types of things. Target talked about, in their last earning report, having $1 billion more transportation costs because of the increased cost of gas and diesel. And so obviously, that might translate to higher cost at Target, right? So it's everywhere. And so that's one of the main key pieces. Today we saw another kind of interesting move, and this is the Consumer Sentiment Survey, which just 2 months ago hit an all-time low. This goes back to 1960. And now we've had a couple of months in a row of increase. It's still pretty low, but the consumer is starting to answer the question of how they feel about their finances and how they feel about the business situation here in the U.S. in a more positive manner. And that's a leading indicator for spending, and which is a leading indicator, obviously, ultimately for the stock market and the economy doing better. So that was another thing that's kind of driving the market today. But here's the key, in my opinion. If you want to follow one thing and really understand kind of what's going on, look at gas prices. Because what's happening with gas price, we'd hit a little bit below $4 a gallon nationwide this week. And the lower gas prices have gone, the more the stock market's gone up. That's it. If you want to follow one thing, and I mentioned this months ago, talking about gas, because it incorporates what's happening in Ukraine. It incorporates what's happening with refineries, which have been shut down, during the pandemic, and whether they're going to be able to deliver more, gas. And it is in everything, almost everything that you do or use. You got your own transportation. All of us think about, going to the pump. Look at the Consumer Sentiment Survey. It has gone up as gas prices have gone down. And when it hit its high point, there is the point in the survey that hit the lowest point in history, right? So definitely a sensitive issue for consumers. 2/3 of the economy is consumers. And so their thought process and how much money they have to feel they can spend has a lot to do with gas prices. And of course, the actual cost of all of these goods has to do with gas prices. So it's still really high. This is just a short-term chart here. But this is probably, if you look closely, obviously the biggest downturn in the price we've had so far in this time frame, and it looks pretty strong. It's kind of moving down, so we'll have to watch. But this is the one thing to watch. If you see gas prices shooting back up for some reason, and there's lots of reasons it could. For example, really, in the situation in Ukraine and Russia, are probably the one that comes to mind the most. Then the market's going to struggle maybe in that time frame. So. So far, gas prices are going the right direction. I'm really very excited about that. So altogether, a pretty good week, actually, a really good week. Very significant, broke through some barriers. We moved back into full allocation. We got some barriers ahead of us, but it is moving very strongly, right, I think, up to those barriers. So pay attention for the next week or two. We'll see what happens with those barriers that are above us, and we'll watch those gas prices and see what happens. So. Very, very interesting week altogether. So look forward to being able to kind of discuss what happens next week at the next show. Thank you.